December meeting. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the programme and Happy New Year, sir. As you think about the risks for 2025, how do you see things? Is the bigger risk an employment stumble or the bigger risk of re-acceleration in inflation?
Oh, I think the bigger risk is reacceleration, not only of inflation, but of the economy, too. We've been seeing the economy. Economists like a term called potential growth, which is not measurable, but what do they think the economy would grow if we're not stimulating it or slowing it down? And that's about 2.5%. 8 of the last 10 quarters, the economy has grown at least at that level, and it's looking like it might do it again in the fourth quarter once we get those numbers at the end of the month. Add into that the inflation rate is not getting to 2%. There is an argument to be made that it is stalling it around, the high twos if you measure it by CPI, because we're at the same levels on year-over-year CPI that we were 7 months ago. And all of this is just suggesting that the acceleration story is going to be the bigger issue. Now, yeah, there's always concern that the labor market could have problems. But right now, most of the data, whether you're looking at claims or unemployment or payrolls, is not really reflecting that concern, at least not yet.
How much, Jim, does this matter to Jensen Huang? Can Jensen Huang keep on delivering a stock market that gains a little bit even on the margins, even with rates going higher, even with this concern that maybe the Fed was mistaken by cutting rates?
Well, first of all, everybody should care about Jensen Huang because he is the most important person in 2025 to everybody's returns, no matter what market you are investing in right now, because NVIDIA is the driver of everything. As far as he's concerned, it should matter at the margin because it will cost his customers with the ability to buy his products, not necessarily his ability to deliver those products. And that's what we have to be careful of. The AI expansion is going to be unbelievably expensive. The energy needs are going to be very expensive. The power companies that are going to have to power it are going to need to borrow a lot of money. And so it's going to matter whether or not the economy does accelerate and they have to pay higher interest costs in order to finance this AI boom.
I guess the larger question here, Jim, is tech outperformance the only thing that can rescue a market with yields where they are, given how much they climbed last year and how much they continue to climb early this?
Yeah, except if you look at the stock market, what's interesting is that the S&P Friday's close was within 1 point of the close the day after the election. So the S&P hasn't really done a whole lot, since election, other than the initial surge on the day after the election. It's at the same level that it was back then. And why is that? Because I think interest rates are getting in the way and that we are at levels that are problematic for the stock market. And if we continue to see any kind of growth or any kind of reason to keep these rates up, it's going to continue to get in the way of the story of, higher stock prices in 2025.
Jim, Speaker Johnson is basically saying we could get this deal done in Washington, one big, beautiful bill by May. Would the Fed then wait on the sidelines, potentially see what those policies look like in May?
I hope they don't. Chairman Powell has talked about this concept of fiscal dominance. And, to put it in very simple terms, it's their problem. It's not mine. My problem is employment. My problem is inflation, being Chairman Powell. And I will set policy based on those. If there's a deficit or if there's going to be a bigger deficit or a smaller deficit, we just had an election. It's their problem to deal with. It's not the Fed's problem to try and accommodate, higher levels of spending or larger deficits.
But if that is the picture that potentially emerges, does that mean that risk appetite can get worse?
It can. I mean, the thing you have to keep in mind is if you go back to 2019, we used to use the phrase, Tina, there is an alternative. There is an alternative now. There's 5 and 6% yields in the bond market right now. There's a 4.5% effectively risk-free money market rate. So you've got alternatives to the market. Now, I know nobody thinks that those are alternatives because we're all stuck on momentum and that the stock market's at 20% years. So therefore, it must mean we're going to have another 20% year in 25 and probably another one in 26. But actually, the alternatives do exist, and that is going to become, a big hurdle for the market to get over.
Jim, heard a lot of numbers forecast on a 10-year yield. I mentioned Jordan Rochester and the team over at Mizuho looking for 5. 5 is more likely than 4 on 10s in the US. Academy's Peter Cheer also said he's looking for 4.75. Nothing about this administration, despite Doge, points to it being fiscally conservative. What kind of numbers, Jim, are you thinking about?
Well, I think that we're going to probably see them take out the October 23 high. That was when we hit 5.02 on the 10-year note. So I'm thinking 5.5. In other words, a higher high than we saw last in 2023 now, 15 months ago. And that will continue the trend that we've seen since 2020, that we're in a secular rise in interest rates. It didn't end 15 months ago. So, I still think we'll probably take out that 5%. And at this point, that's 40 basis points away, maybe 50 basis points away. That's not that far away when you think about the scope of, you got an entire year to potentially reach that target.
Close to 4.60 this morning, Jim. Appreciate your time. Jim Bianco there of Bianco Research, looking for yields to breach